Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts and practices that can help you succeed. Today, we're going to talk about balance sheet basics, a fundamental concept that every business owner, entrepreneur, and investor should understand. So, what is a balance sheet? Simply put, it's a financial statement that provides a snapshot of your company's financial position at a given point in time. It lists all your assets, liabilities, and equity, giving you a clear picture of where your business stands financially. Think of it like a report card for your business. It shows you what you own, what you owe, and how much your business is worth. But why is understanding balance sheets so important? Well, it's because they help you make informed decisions about your business. By analyzing your balance sheet, you can identify areas where you need to improve, spot potential problems before they become major issues, and make strategic decisions about investments, funding, and growth. In short, a balance sheet is a powerful tool that helps you navigate the financial side of your business. The concept of balance sheets dates back to the 15th century, when Italian merchants used them to track their assets and liabilities. Over time, the concept evolved and became more sophisticated with the introduction of new accounting standards and regulation. Today, balance sheets are an essential part of financial reporting and are used by businesses of all sizes and types. So, what are the core principles and theories behind balance sheets? At its simplest, a balance sheet is based on the accounting equation: assets equal liabilities, equity. This means that your assets must equal your liabilities plus your equity. There are also several key concepts to understand, including asset valuation, depreciation, and amortization. Influential thinkers like Alfred Marshall and John Maynard Keynes have shaped our understanding of balance sheets and their role in economics. Marshall, for example, emphasized the importance of understanding the consequences of financial decisions, while Keynes highlighted the need for governments and businesses to work together to stabilize the economy. Companies like Apple and Amazon use balance sheets to manage their finances and make strategic decisions about investments and growth. For instance, Apple's balance sheet shows that the company has a huge cash reserve, which it uses to invest in research and development, make acquisitions, and pay dividends to shareholders. On the other hand, companies like Enron and Lehman Brothers failed to manage their balance sheets effectively, with disastrous consequences. Enron's balance sheet was notoriously complex and misleading, hiding billions of dollars in debt and liability. When the truth finally came out, the company collapsed, taking thousands of jobs and millions of dollars in investments with it. So, how can you apply balance sheet basics in your own business or career? First, make sure you understand the accounting equation and the key concepts behind balance sheets. Second, use financial software or accounting apps to streamline your balance sheet management and stay on top of your finances. Third, regularly review your balance sheet to identify areas for improvement and spot potential problems before they become major issues. Research has shown that companies that prioritize balance sheet management tend to outperform their peers in terms of profitability and growth. A study by McKinsey found that companies with strong balance sheets are more likely to invest in innovation, expand to new markets, and attract top talent. On the other hand, companies with weak balance sheets often struggle to access capital, invest in growth initiatives, or respond to changing market conditions. To take it to the next level, consider using tools like financial ratios and metrics to analyze your balance sheet and identify areas for improvement. For example, you can use the debt-to-equity ratio to assess your company's leverage and the current ratio to evaluate its liquidity. You can also use benchmarking to compare your company's performance with that of your competitors and identify best practices. In conclusion, balance sheet basics is a fundamental concept that every entrepreneur, business student, or investor should grasp. By understanding how to read and analyze a balance sheet, you'll be better equipped to manage your finances, make strategic decisions, and achieve long-term success. As the great economist Alfred Marshall once said, the whole of economics may be reduced to a single lesson, and that lesson is, things have consequences. And when it comes to balance sheets, the consequence of not understanding them can be severe. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move by taking control of your finances, analyzing your balance sheet, and driving growth and profitability in your business. Join us next time as we explore more essential topics in the world of entrepreneurship and business.